2007, a seat holder, and I went from being a seat holder at the exchange when it became mutualized. I became the global economist and chief market strategist for the Capital Group, the world's largest trading organization, and I was also managing director of sales and trading. After that, which after 7 years, I became more and more involved in public company boards as both a director of placement service with Strategic Board Solutions, another company that I founded, but also through my involvement with several public companies as a director. It is through that experience that I was able to really gain a tremendous amount of insight into ESG, because when I started in the public space in 2012 as a director, it really was not mentioned all that much in the boardroom. And now it is the dominant theme that we discuss in all the boardrooms that I serve. And I thought that this opportunity to be here to talk about this now is very, very, very timely. So that's sort of my background. That's where I'm coming from in the space, and that's why I guess I'm here. But I'm going to let everyone on the panel introduce themselves, and I think you'll find that the combination of experiences and perspectives is profound and unique. So I'll start with Erin.
Thank you, Peter. Hello, everyone. I actually started my career at Knight Capital Group, which is where I met Peter several years back. Most of my experience has been in the financial services asset management field. Right now, I'm currently working with a clean energy trading company, which has spurred my interest in ESG quite a bit, and I have learned a ton. Also very interested in board service and all that ESG, the impact that ESG is having on the boardroom. I think initially when ESG started to become a thing before it was even called ESG, it was socially responsible investing. And I think that it got a relatively harmful stigma to it during that time, because people looked at it as, oh, we're just not going to invest in these companies because they do bad things. And given that the financial industry is made up of a lot of capitalists, this was something that was not interesting to them. And ESG has evolved incredibly, and throughout the 2000s into the 2010s, it has changed into ESG and impact investing and overall sustainable investing. And I think it's important to recognize the difference in these things. So ESG is primarily a risk assessment. It's something that companies do. They look at their E, climate and environmental issues, their S, their social issues, and G, the governance of companies, to figure out what are our risks, what are the things that we should be focusing on to make sure that we can sustain in the long term as a profitable company. Impact investing is a bit different because it's not a strategy in and of itself like ESG is, but impact investing is the double bottom line. How do we make a strong financial performance but also make an impact in the world? And the fact that so much money is becoming controlled by both millennials and Gen Z, and this is going to accelerate significantly over the next decade, they care. It's a generation that cares about making an impact. And this just causes the acceleration of, the venture funds and the PE funds caring. The number one reason that any investors care or any companies care about ESG is the investment risk. The second reason, which is pretty close to that, is that clients care. So this is something that is just really, there's not going to be a choice to be made. It has to be an issue. It has to be cared about in the boardroom, across the company. Stakeholder capitalism is going to be here to stay. So I think that that's just something that's that's really interesting to think about. And I will pass on to Jason to tell us more.
Perfect. Appreciate it. Jason Marisis, currently lead digital product management for Credit One Bank. I have not previously worked with Erin or Peter, but it's been a pleasure getting to know them over the past few days.
Sorry, Jason.
My background, 15 plus years in product management, business management, worked across a variety of industries, which really helped shape perspective. News media, financial services being the dominant one, in addition to e-commerce and a few others as well. Big companies, right, large corporations like Capital One, in addition to, starting a number of smaller businesses. I think where I am today in terms of ESG, what's sort of important to me, right, is how can businesses essentially be socially responsible and well managed, right, while also sort of echoing Erin to some extent, managing that double bottom line. I think from an investor perspective, they're obviously, right, looking to make money. Returns are critically important. I think at the same time, there's sort of a lack of awareness around the ability to focus on social responsibility, environmental issues, and the like, in a way that can also be profitable. A lot of times in conversations you hear, it's either this or that. We could make money or we could be socially responsible. But ultimately, how do you move the needle, right, and drive impact while focusing on both? And that's something that, all opinions are my own here, but for Credit One, we're hyper-focused on how do we help 15 million customers essentially make better financial decisions and, live more financially stable lives and achieve their goals, while also at the end of the day, ensuring that the bank ultimately makes money. So in any case, I think for me, my perspective, ESG, certainly to some extent, risk assessment at the same time. I think the sort of bigger, broader, more salient themes are equally as important as, business leaders today and future leaders of tomorrow. Sort of essentially figure out and decide on where to focus, what opportunities make sense from both perspectives, social and business.
Go ahead, Mark.
Passing on. Hi, my name is Mark Feldman, and my background is in investment banking, corporate finance, which I've been in the space for now over 30 years, running our own investment group in New York City for 11 years, and then after selling it, moving to Moscow, Russia, where I started an investment banking group, which is still around without me, but running well, and I've been involved there in mergers and acquisitions for the past 15 years. And I have seen how the space, even maybe in less responsible countries like Russia and Ukraine and countries of old CIS, have been changing and improving, considering the ecology, considering the investments that they would like to attract. I was focusing on proper governance, on answering issues in ecology, and myself actually, I've left the space 2 years, well, started about 3 years ago, but left the space 2 years ago to focus on blockchain space, where about 2 years ago we launched a blockchain called Everscale Network. It's a global, fully decentralized blockchain with now over 500,000 members all over the world. And one of the things that we've been focusing on as of late is, or in the process of, is creating a DAO ESG. So our DeFi Alliance have separated over $200 million to the fund to focus on companies that create solutions for the space. We truly think that blockchain brings a lot of innovation, a lot of unique products to the space which did not exist before, that helps ESG space or responsible investing to grow much faster. And the focus, as I said, of our ESG DAO is invest in young companies that are bringing solutions to the ESG space through blockchain. I think that again, responsible investing is very, very important. And even in that space, outside of solutions that blockchain brings, it truly helps. I think the very important thing that blockchain brings, which is trustability. It's a very interesting subject. It's a subject that I think is not just focused here in the United States, but truly is being addressed all over the world today. And hopefully, with our help, we'll continue to grow. So, thank you.
Hello? Hello? It's on. It's on.
I think it's on now.
No, before.
Okay,
This looks good. Yeah, now we're on. Hi, everyone. My name is Eric Evans. I'm so glad to be here and to share the dais with my compatriots here who have so much experience with ESG. Yes, an interesting area. It's going to change dramatically, I'm sure. But I've been in the investment banking business for about 40 years, both on Wall Street and with my own boutique investment banking firm in Connecticut. So what we do is to primarily to raise capital for early stage companies. And that's my focus. And my focus today is to talk a little bit about governance, because I think it's so essential and important. And important to those of us who like to make these investments as angels or otherwise investing in early stage companies looking for dramatic returns over the long term. And the lesson that I have learned over my years in accomplishing this with my clients is that to start with governance very early on with the founder and other individuals possibly in a new company who are starting the new company, because once the company gets out of the gate with some capital and going, it may be too late and too difficult to find out that governance isn't part of the mission. And that's been my experience. I've had clients where the founders have very good governance, and I've had some, not all fortunately, but some where governance is just left behind. And it's left behind frequently because the founder is in love with his idea, his or her idea, and the company they've started, and they want to control this company. So I would like to just focus on that, because I think it's so important to understand it and understand the effect of good and bad governance. About 3 years ago, before COVID, I had made a relatively large investment in a cybersecurity firm. The founder of the company is somebody I knew for 35 years, and I thought I pretty much knew what this gentleman was all about and felt comfortable investing in his company. But sometimes you never know about people. Very often there's a issue, what I'd like to call is underneath the underneath, and it's very hard to get a handle on it. One of the things I've learned is that to raise capital for these companies, you need two ingredients. One is excellent management. The founders and the founders team need to make their milestones so the valuation of the company can grow over time. And the other is to have a very, very large market. Those are two essential ingredients to be able to raise capital and grow the company. In this particular company, this cybersecurity company, there were 14 patents The founder made a very clever move, and something that still I think a lot of people don't know, but if one is over 65 years old, 65 or older, they can get a patent through the United States Patent Office within a year. It generally takes somewhere between 3 to 5 years to get a patent approved or disapproved. So this company had 14 patents. That was a real strong aspect to the company. I liked it, and I knew the founder, as I said, for so many years. One day, we were having a phone call with the management board, the management committee, the founder, myself, and new management that was coming on to take the company forward. And the founder, in the middle of the call, decided to change the plan for the company dramatically. We had 3 different clients lined up to use this technology. We had 4 individuals to come in and run the company from a professional point of view, 4 people from Silicon Valley. I had raised a fair amount of capital for the company and was ready to raise even more, and this business plan changed without any conversation whatsoever on this phone call. So I started to look into something called an operating agreement. This was a limited liability corporation which operates under an operating agreement which the company needed to have from the get-go. And it turned out that it was basically impossible to change the control or even modify the control from the founder to a more broader experienced board or management committee. Every which way we turned with lawyers, it was not possible to do. And you know, I had to, and I had not only my own capital in it, but capital in it from friends of mine I had known for 40 and 50 years. So I was very, very upset. I tried to recapitalize the company. I could not get it done. And at some point, I decided, you know, I can't deal with things I can't control. I can only deal with things that I can control, and I couldn't control the outcome. So instead of getting sick over it, I gave up on it, and I've continued. It just happened that way. But I learned a great deal, probably more from that particular transaction about governance in particular than I could have learned from many, many other transactions that I've done that were successful. And that's the way it works in life sometimes, and that's the way it worked for me. So governance is what it sounds like. It governs the company, and it can govern a company dramatically. It can be extremely helpful, and it can also be a death knell to the company. So I appreciate the time that I have, and I'm going to turn my mic back over to David.
If I could add one comment to that quickly, I had a very similar experience with my co-founders of another company that will remain nameless, but the company hit a hard time, and it was up to one person that was able to make any changes to the company, and the rest of the management team wanted to be involved and almost kick him out just to start new management, take the company in a new direction, and we were not able to because he had such power under the LLC agreement. So I share your feelings on that.
Thank you.
And that is actually what brought me into my interest in board service, because I realized you cannot run a company without good governance, and you also cannot get the E and the S in ESG without the G.
And I'd just like to add to that, and that's the whole, I think, really important takeaway. ESG, environment, social, and governance all matter, but it's the last alpha symbol, governance, that actually fuels both the environment and the social components of ESG. It's all about governance. If you're a public company and you're being rated on a number of different metrics by ISS or Glass Lewis, increasingly what the regulators and the stock services are looking at is governance first. I serve on a governance committee of a company that manages about $35 billion in assets. Our notes are going over by the regulator. Every single word in those committee meetings is going over by regulators. It is very, very, very important. And I think we would all agree, and Mark may have a very specific, and Jason as well, a specific take on the importance of governance. And I could just say this much, with public companies, you have independent directors for a reason, and their number one priority outside of succession planning is governance. Particularly in companies where you have founders, where founders are basically have put themselves in a position where they cannot be held accountable to any other opinion or outlook. That's a governance issue, that's a governance deficit, and that's a big, big problem.
Very big problems. Same. I have a personal story of an investment group that we created in the early 90s, and in 1999, one of the major British investment houses wanted to buy us out, and basically we all agreed. Well. Except for the founders, or decision was basically behind the two founders that the company should have been sold, and they just felt during the bull market that this is going to go and the evaluation in a year are going to be greater. And we said, look, we're selling at an incredible multiple. And they said no. And then 2 years later, in 2001, we sold the company for a fraction of the first.
Perfect example. Yep. Founders have a way of representing their interests in a way that really is devoid of objective data.
Yeah,
it's ego-driven.
Yeah, we were also investors during the time. So we were not founders, but we were investors. And investors should have overseen that the proper governance was put in place to protect their investment and their decision making. And absolutely.
Jason.
Yeah, look, so for one of the businesses that I started, a fintech business, one of the sort of first focuses was to put in place a board of advisors, right? And there, interestingly enough, to your point, their advice was to think about the operating agreement and the governance of the company. As the founder, I of course said to myself, wait a second, I want to maintain control of the company, but then from a forward-looking standpoint and from a risk mitigation standpoint, very quickly realized that probably wouldn't be in the company's best interest. So, had two co-founders at the time as well, and we sort of worked with the board of advisors to figure out sort of how to put the proper controls in place if certain decisions are made, and others don't agree. Let's not move forward without, sort of, killing the company, right? Because in some cases, right, an indecision is in fact a decision, and as a startup with a limited amount of capital, limited runway, it's live or die every day. But fast forward, that ended up working out in our favor. If it were for me, would have focused the business on a certain segment of customers that ultimately wasn't the most fruitful. We had to have a series of conversations with our advisors, with our investors, with, of course, the core team to figure out from a pivoting perspective, how the business should adjust to some of the changing sort of dynamics, right, in the economy. Ultimately, we did end up shifting and focusing in a different direction. So this is sort of a moral of the story, right? Governance is critically important, and even as a founder going forward, for those of you who either run businesses or are considering starting a business, you of course always say, you have a vested interest in your business, you want to see it succeed, but I think taking a step back, sort of words imparted to me, right? Taking a step back and sort of recognizing that you may not be always right, and those checks and balances should be in place to run a healthy, sustainable business that will generate value for the long term is critically important.
Let me just, if I can, thank you, Jason. I just want to emphasize again something I said at the beginning of my talk, and that is what I learned from this. And what I learned was to get involved with governance early, because the founder has his or her own agenda very often. Not all the time, but very often. And that agenda may have been early on given to the founders, to an attorney. And the attorney's responsibility is to somehow integrate that vision into an operating agreement at the very beginning, because you have to have an operating agreement. I think in some states it's part of the regulations. If you have an LLC, you got to have an operating agreement. So the operating agreement may be written to protect and give power to the founders of the company. When we invest as angels, very often there's some emotion involved. We want to make the investment. We do as much due diligence as we can, but we're just an investor. We may not have access to all the due diligence that we would like, and it becomes too late, and there's nothing that we can do about it, and the founder has an amount of control that's inappropriate. So I just want to emphasize that again, how important it is.
Just to add to that, I think you and I, because we're dealing with young companies, and to take them to the next, help to take them to the next level, have a great place to really deliver the message to these guys about the governments and how important to them, and what Craig said regarding the fact that it's important for them to learn to realize that they may not be right all the time. So.
Thank you. Yeah, that's great perspective. And I think clearly we all agree that governance is the capstone of the ESG push. We've seen that in all of our lives, in all the businesses that we worked in, with all the people that we've worked in, founders, co-founders, et cetera, public, private. And then just to move on from that, and something that I think is probably more commonplace in terms of the media coverage of the ESG space, and that is environment. The company that I just mentioned that I serve as the lead independent director of is a company that is very, very committed to the E part of the ESG. We just finished a 295,000 square foot headquarters, and it is completely fueled by solar power. And all of our 250 branches will be completely fueled by solar power, so much so that we build our own wind farms. And we're a bank. That's how much of a commitment we have made to the E in ESG. And that comes from governance. Governance was behind that. Management was clearly behind it. But governance, our governance team was very, very about approaching the problem solving from a way that was completely vertical, so that we were able to address our ESG priorities independently of any other function that may have been a variable that would not have allowed us to do it. And I know you can speak to the environmental component of this as well, Erin.
Sure, yeah. I think there's three big risks when it comes to the E in ESG. The first one is physical. Are there going to be major hurricanes and storms, and what are we going to do if our people are, displaced from their workplace? COVID is a good example that was kind of indirectly related to climate change. Then there's the transitional risk. Disruption in the space, what happens as you have to adjust to becoming a more climate-friendly company, given that the SEC has put out a proposal for disclosures that will potentially become mandatory for at least very large companies. What do you do in that situation? And then the third one is reputational. And given, again, the millennial and Gen Z representation that cares so much about climate change, because they're the ones that will be affected, their kids will be affected, their grandkids will be affected, they want to work for companies that care. They want to invest in companies that care. They want to, they are a major stakeholder in climate change, from a company perspective, from a personal, from a community perspective. So these are three big risks that companies have to think about when they think about climate change. And I think that it all does start with governance and caring at the top that this is going to be an important issue. And whether it's because you're someone who wants to save the world or you're someone who wants to have a long-term, sustainable, profitable company, it matters. No matter what your feelings are on science or whether it's going to damage you in your lifetime or not, or whether you have kids or not. It's just going to become something that cannot be avoided. And what companies need to do is recognize that it's not just a risk, but it also presents opportunity. And I think that's true across the ESG spectrum. And a perfect example is when you go into your hotel room upstairs, there's a sign in the bathroom, if anyone has checked in, that says 794 million gallons of water have been saved in the last 5 years. And that's brilliant because people, one, that's great for reputational. They think MGM Resorts or the Mirage cares about saving water. And we're in Nevada, a state where there's a shortage of water, and it's important. And also, it saves a ton of money for the hotel to have the people that stay here save water and use less towels.
And that works because they actually, the Mirage places that card in the bathroom and it says, effectively, do your part to help us do our part. Mm-hmm. So there's buy-in immediately, which is very effective.
Yeah, I mean, it saves the company money. It's great for the environment. It's great for everyone. It's great for the reputation. So it's a win-win situation. And I think if companies approach the climate issue as something that can be an opportunity, that they can improve the way that they appear to others, they can improve their bottom line by caring about it. And just the fact that there's so many small climate tech companies, and my company is we have software that predicts prices in the energy markets all over the country, and we use that technology to manage renewable assets. And the whole goal is to make these assets more profitable, which produces a larger amount of development of these projects, which increases the integration of renewables into the grid and increases decarbonization. And that's a very difficult thought path to follow, but it's very, very much built into the DNA of our company and into our culture and into the people that work at the company. They care about this mission, and we would not have been able to hire the talent that we have if we didn't care the way that we do.
Jason, have you seen the same sort of governance-fueled approach to environment in your space?
Yeah, so I think in the financial services sector, right, at least, my 2 cents on this, from an environmental perspective, I think that typically isn't the first and foremost approach, right? The business is still focused on the business, making money, right? But I think at the end of the day, and, worth underscoring here, is highlighting the fact that there are win-win situations. And, you mentioned building the building that you did, right? It's a double win, along with a number of other opportunities.
Double bottom line.
Exactly. And I think from our perspective, that's where the interest is. And it's sort of twofold, right? From a business perspective, make money today, right? So there's sort of that short-term opportunity. And then there's sort of the medium to longer term opportunities. Where can we invest in a way that makes sense, for our investors? We happen to be a privately held company. So that they could achieve the returns that they're looking to achieve over their allotted time frame. If the numbers work out, absolutely, right? It makes perfect sense to invest in certain areas. If they don't, well, then the question is, okay, we may not invest in that area. What other areas could we invest in a way that, basically focuses on that rising tide that lifts all ships? Again, for us, and, we see this across a number of financial institutions and, certainly the fintechs in particular, they are looking to focus on the customer first, right? It's sort of human-centered design, solve for their acute pain points, right? Add value for them, and then the money will follow. And I want to stress the importance of both.
Yes.
And it doesn't have to be an either-or situation.
Yes, which is, I think, is the way it's commonly thought of.
Right, exactly.
Mark and Eric, if you'd like to add any thoughts. I know, Mark, you've got some incredible perspective on governance.
No, you know what, as I was thinking more, that I think that the younger generation is becoming much more responsible, obviously, with time changes and climate changes and everything that's going on in the world. And I think that one of the important things is to truly help young generation by, putting these things not just, a company's perspective on things, but maybe through education as well, through high school education, through college education, through maybe putting in, I don't know, a must in the interview for a company for a young guy to say, oh, do you know what ESG is? Okay, and as an important answer. So I think.
Yeah, that's interesting. I have a son who's one of these younger individuals you're speaking of. He's 21, and the environmental problems that the world has today are my fault and my generation's fault. And I just sit there when he doesn't do that anymore. He's kind of wondering how I got so smart so quick. But I just scratch my head, and I don't get into a discussion about whose fault it is. I just say, a person's either part of the problem or part of the solution. Doesn't matter whose fault it is. If you want to change something, then you have an opportunity to do that. And I just laugh at his comments about my age. It is what it is. So.
Yeah. We have under 2 minutes left, and I just wanted to give everybody a chance to say a final word. For me, I'm very privileged to be here. I'm honored to be a part of the Money 2.0 presentation conference. It's been a tremendous joy, and meeting these three new friends has been really special. Of course, I've known Aaron since 2007, 6, somewhere around that. But looking forward to staying connected. Definitely want to know more about everything you guys are doing. So any final words from anyone? We've got about a minute.
I think one thing that we didn't touch on that I'd encourage everyone to kind of look into a little bit is the reporting and the frameworks that exist within the ESG world. I think it's just going to be a very important topic over the next several years, how performance is reported and standardized. Right now it's very fragmented, and several companies are reporting voluntarily certain things, but that's all. Thank you.
Look, again, just want to sort of reiterate, appreciate the conference having me. Pleasure meeting everybody. It's been a real joy. Looking forward to staying connected as well. I think my final word is, from an ESG standpoint, many business leaders don't believe this could be a win-win. It absolutely can.
Right. Same thing. Thank you, everybody. Thank you for being here. And please take a look at solutions on blockchain. It's really changing the world for ESG.
And the same. I've enjoyed meeting all of you, and hope we can stay in touch. And I'm very grateful for being here and being invited. And as far as ESG, when we pulled up to the hotel, stopped to get out, there was a driverless car next to the car that delivered me from the airport. So that's the first time I've seen one. That was really cool, and now we're sitting up here talking about ESG.
Thank you very, very much, and thanks for having us.
Thank you.
Thank you.